Welcome to the Real Estate Prosperity Podcast. My name is Robert Metz. I'm the author of the just published book entitled Real Estate Prosperity. My book is available in both e-form and hard copy at www.realestateprosperityllc.com. This is a fifth in a series of podcasts which are dealing with the 28 methods by which you can finance or control your purchase. Whether you're buying a property and taking title with actual financing, or whether you're quote-unquote buying a property and taking title or not taking title at the moment and not getting new financing, but rather taking advantage of other means to fund or quote-unquote finance your purchase. Now, in our fourth podcast, we were discussing the various forms of what's sometimes commonly called conventional financing. Aside from those methods that we already discussed, assumptions, some conventional methods, we cannot overlook a very important method, which is sometimes referred to as the all-cash or no financing contingency offer. When you're buying a property, especially if it's a property in foreclosure where you have a very motivated and sometimes anxious seller, or whether you're buying a bank-owned property, typically called an REO, real estate owned, where the bank has already foreclosed on the property and they're looking to get rid of it, the bank does not want to deal with offers that are going to be lingering or falling through if they can help it. So in both of those scenarios, a foreclosure or an REO purchase, or indeed in many run-of-the-mill garden variety purchases, many situations of distressed properties, non-distressed properties, good buys, marginal buys, seller looks for a strong deal, offering all cash or a no financing contingency offer, meaning your contract is not subject to your getting a mortgage in order to close, is a very powerful bargaining tool. It makes for a very powerful and valuable offer or contract. Sellers like to see an all-cash offer. Now, when you tender an all-cash offer, or an offer 6 of one, half a dozen of another, that says no financing contingency, no mortgage contingency, it's not subject to your getting a mortgage, you're bound to close whether you have the money or not. Depending on the situation, prior to closing, prior to even contract execution, the seller may want to be able to verify that you have the funds available, or that you have other assets, other equities from which you can draw the funds. Those assets or equities may not be able to contribute those funds when the time comes to close. The funds that you have available may not be there and may not be available when time comes to close. So there's a bit of a risk for the seller, but at the same time it's a stronger deal, especially if the seller has a 10% deposit either in hand or in escrow from the buyer. Because if the buyer does not perform and does not have a mortgage contingency that he can possibly use or manipulate to wiggle out of the contract with, he can be in breach, and the seller can be looking at a 10% forfeiture plus other damages as a result of that breach. So, an all cash or a no financing contingency offer is a very powerful negotiating tool for the borrower. Now, the borrower, and I use that word not tongue-in-cheek, but literally, the buyer can be the borrower even if he has an offer that says he's not going to borrow. You can have an all-cash offer, but that does not prevent you from closing with a new mortgage. You as a buyer, you as a borrower, in this case, run the risk that if you don't have a contingency that you can escape from the contract if you don't get financing, that you can be held in default, sued, lose, etc. But it's a trade-off. You have a strong offer and you have a risk. If you're confident that you can get all cash or you can get your financing, you're in good shape. You got a strong offer, it's valuable. It's a valuable tool to negotiate price and other terms. So you can close on an all-cash offer that has no financing contingency. You can close with a mortgage. Obviously, you can close without a mortgage and take a mortgage finance, pull some money out immediately after the closing also. Bottom line is, if you don't get your mortgage and you need to mortgage, you need to borrow money to close, you have a problem. If you're in a position and you can still do your financing and close with a mortgage, you've got the best of both worlds. You've been able to borrow the money and present yourself as a very strong all-cash buyer, negotiated in all probability a better deal as an all-cash buyer, and still gotten your mortgage to finance with. Again, there's obviously a certain risk, but if you know you have the money or you can get the money, despite the gamble, with a degree of certainty, an all-cash, no contingency offer, especially from a knowledgeable, sophisticated speculator or business person, is a valuable tool and can make a lot of money for the buyer. Now, in addition to the methods that we've already discussed, another method to finance or control the property is by using an equity line or a line of credit. If you have an equity line, which is basically a form of a mortgage in which you do not draw down all of your principal at once, and you have it on call, so to speak, you pay interest on it when you use it, when you take it, you can have an equity line or a line of credit on a property that you already own. You can place it on the property that you're buying. Again, it's a version of a mortgage. You might have it in conjunction with other properties in a real estate business, or you might have it on other business entities as a business person having nothing to do with real estate. So having an equity line or a line of credit available is a very valuable tool and offers you, again, an opportunity many times to present yourself as an all-cash buyer and better negotiate. So the equity from one property can easily fund another property in any case. A bridge loan, which is not necessarily an equity line per se, a bridge loan is typically what it says. It's a bridge, a vehicle to go from one transaction to another. Often a speculator or a self-user, as you might call an owner-occupant, is selling a property and going into another property. They need the money from the property they're selling to finance a new property. They haven't closed in time, depending on their financial position, namely credit, income, etc. The type of purchase, how much they need to borrow versus the true value of the purchase, and the amount of equity they have or they're looking to pull out of the property that they're selling. Depending on those factors, banks and mortgage companies do lend what's called bridge money, whereby the mortgage encumbers both the new property that you're purchasing and the property that you're selling. It ties both properties up. It's basically an interim loan to be paid off when the property that you're going from is sold or otherwise liquidated. Bridge financing is sometimes difficult to arrange, but if the equities are there and the credit situation is satisfactory, bridge financing is very common, and obviously it's very valuable. Hard money is another category of money, another category to finance or control a transaction. As we speak today, hard money is maybe 9.5%, 11% interest, maybe a few points up front. It's not quite as hard as it used to be. A few odd years back, hard money was routinely 15%, 19%, 3.6 points. Very short term, some very harsh terms in terms of remedies for default, for late payments. With the softening of the mortgage interest rates in recent years, hard money has become, you might say, not quite as hard. Hard money, even when the rates are higher, depending on the transaction, again, can be extremely valuable. The novice should not fool with hard money. Hard money is, some people say, for the desperate, and sometimes it is, and sometimes the cost and risks of the hard money are not worth it. It's better to stay away from it. But for somebody who knows what they're doing, has a little experience in real estate, has some wherewithal, is buying something and the numbers are really right, and is maybe just short the money short term, maybe needs to get into a deal or wants to get into a deal quickly, that there can be some huge rewards, looking to flip a property, hard money, and again, especially today where it's not so hard in terms of the rates compared to yesteryear, hard money is a very valuable tool, very valuable technique. Hard money is typically available from some smaller institutional lenders and niche lenders. Some of them are kind of off the radar, so to speak. They do not comply with the banking regulations in a given state. Some of them are pretty unscrupulous, but there are a large number of hard money lenders who are legitimate business people looking for a higher yield, looking sometimes to participate in a deal, dealing in more risky situations, and they're not all unsavory characters, although some are. Bottom line, especially for the speculator, having recourse to hard money for a deal that has to close quickly, deal that has great potential, where you might be in a bind, where you might be depending on something else to close, and it fell through at the last minute, and you don't want to lose a new deal, you don't want to have more damages. Hard money can be a very valuable tool. Deal with hard money only with reputable lenders, whether it's a small niche lender who does a half a dozen deals a year, or a larger niche lender, but deal with reputable lenders, a reputable attorney who knows what he's doing, and make sure your numbers match. And if you get shorter term hard money, that you can bail out, that you can have cover ability, either from the new property or from other resources, to pay your hard money off if you have a balloon or some other term date that comes due on short order. But do not overlook the value of hard money when you are pressed and you have a good deal at hand, some knowledge, and proper representation. There's a whole category, a whole bailiwick of financing that's sometimes called venture capital, creative financing. And you can define it almost as the terms imply. The imagination can lead to many possibilities. Venture capital. There are all kinds of lenders, all kinds of business people, real estate and otherwise, who are looking to put money into deals where they feel that they can make a dollar, where they're looking to do a certain risk, but at the same time, they're reputable business people and they're looking to participate.